On July 28, 2026, broad U.S. equity markets posted solid, unexpectedly strong gains. The Dow Jones Industrial Average jumped over 1%, and the S&P 500 closed in the green. But that headline stability masked a brutal divergence in the technology sector. The Nasdaq slipped, and South Korea's Kospi wiped out nearly 11% of its value, triggering trading halts. Digging into stock-level data, Apple crossed a $5 trillion valuation, while semiconductor darling Micron plunged 8.4%. This decoupling runs counter to the prevailing market logic of the last several years. Up until this point, semiconductor and artificial intelligence stocks were the exclusive engines driving the broader market rally. The scale of these moves suggests a forced, massive reallocation of institutional capital, seeking shelter from a sudden structural break in the market. We can classify this as a convergence event. That happens when multiple, highly independent macroeconomic variables trigger at the exact same time. The first variable was a massive sovereign-level disruption, physically cracking the established global semiconductor supply chain in half. The second was a rapid, geopolitical-driven deflationary pulse throughout global energy markets. The third was a structural repricing of the U.S. term premium, engineered by a new regime at the Federal Reserve. To accurately map where institutional money is moving next, we have to deconstruct how these three simultaneous shocks dismantled the AI hardware monopoly. The catalyst for that 11% wipeout in the South Korean Kospi originated in Beijing. Reports confirmed that China had officially begun mass-producing domestically developed immersion DUV lithography machines. DUV, or deep ultraviolet lithography, is the critical chokepoint technology required to manufacture advanced microchips. Without it, you cannot scale semiconductor production. This map shows the previous hardware monopoly, heavily concentrated in Taiwan and South Korea. But as China spins up its own massive manufacturing capabilities, that bottleneck is broken. This creates an immediate financial threat to incumbent chipmakers like Samsung, SK Hynix, and Micron. A sovereign competitor injecting cheaper, state-backed manufacturing into the global supply chain compresses profit margins across the board, absorbing market share. The era of uncontested, high-margin AI hardware production is over. The market is now permanently discounting the future earnings of these legacy semiconductor giants to account for the new competition. If the companies building the chips are facing margin compression, we have to look at the big tech companies buying them. These firms are currently sustaining massive, ongoing capital expenditure budgets to build out their AI infrastructure. This chart maps a critical financial inflection point. Despite robust operating cash flow, Alphabet recently reported its first-ever quarter of negative free cash flow. Their massive $205 billion capex budget pushes the net total negative. Big tech can no longer self-fund these AI ambitions entirely from their own profits. To survive the build-out, they are forced to tap the debt and equity markets to cover the shortfall, as seen with Alphabet's recent $80 billion stock sale. This shifts the fundamental risk profile of these companies. The long-standing assumption was that mega-cap tech stocks held so much cash they were effectively immune to macroeconomic borrowing costs. Because they must now borrow to build, their valuations and the ultimate return on investment for these AI projects are now dangerously tethered to the Federal Reserve's interest rates. On the exact same day the tech sector reeled, global energy markets experienced an equally massive, yet seemingly contradictory shock. This chart tracks the trajectory of crude oil. After a steep 2-week surge, prices plummeted. Brent crude fell 6.5%, and WTI dropped nearly 8%. The drop aligned exactly with headlines out of the Middle East, confirming that the United States and Iran had agreed to pause military strikes. That pause instantly wiped out the geopolitical risk premium that had been priced into oil. Cheaper energy costs flowed directly into the broader economy, acting to cool short-term headline inflation. This creates a paradox. If inflation is cooling due to cheap energy, bond yields should be falling, which would make big tech's new debt cheaper to service. But the exact opposite is happening. Instead of falling, long-term borrowing costs are punishingly high. Mortgage rates have surged past 6.8%, and long-term treasury yields have hit 52-week highs, completely ignoring the drop in oil. To understand why, we have to look at the Federal Reserve under its new chair, Kevin Warsh, and his strict commitment to long-term price stability over short-term political pressure. The yield on a long-term bond is made up of two stacked components: basic inflation expectations and a metric known as the term premium. The term premium is the extra compensation investors demand to lock up their money for decades when the fiscal and geopolitical future is highly uncertain. Notice that while inflation expectations remain flat, the term premium expands rapidly, pushing the total yield up. Chair Warsh has effectively ended the Fed's era of forward guidance. By refusing to telegraph the central bank's future moves, he has intentionally made monetary policy less transparent. Removing that transparency skyrockets market uncertainty. That forces the term premium higher, creating an insurmountable cost of capital ceiling for debt-dependent AI companies trying to fund their hardware build-outs. The market anomaly from the opening bell stems from a specific intersection of data. Tech found itself caught in a vice, squeezed by rising sovereign chip competition and the debt costs of an expanding term premium. Institutional capital ruthlessly reallocated to sectors immune to these specific shocks. This heat map visualizes the rotation. Institutional money is flowing out of high-duration tech and directly into defensive sectors like consumer staples, value, and healthcare. Companies with strong free cash flows became immediate beneficiaries. Coca-Cola rallied 4.5%, and Boeing jumped 4.9% on positive cash flow. In a high-interest rate environment devoid of Fed handholding, institutional money demands assets that generate cash today. They are actively rejecting the distant, expensive promises of AI. The July 2026 Convergence event signals a fundamental challenge to the AI bull market. Blind technology investment, previously supported by zero-interest cash reserves and predictable Fed guidance, now faces a multi-front headwind. Future equity valuations are increasingly dictated by sovereign supply chain security and the true unsubsidized cost of capital. The previous decade relied on the safety of Fed forward guidance. Today, investors are navigating volatile term premiums and geopolitical hardware wars. Surviving this market environment requires looking past the long-term potential of artificial intelligence to calculate exactly who is taking on the debt to build it.